All right, let's break down what could be a huge turnaround story for Outdoor Holding Company. After a really long stretch of restructuring, the company just dropped its Q2 numbers, and the way the market reacted, well, it suggests something big has finally changed. So let's dive right in.
Wow, an 11% jump in pre-market trading? Look, that's not just a modest beat. That's a massive signal that something fundamental has shifted here, and it clearly caught Wall Street completely by surprise. So what was actually in the report?
So what's the big headline? It's simple, really. A comprehensive beat, right across the board. And remember, this is happening in a really tough environment for consumers, especially in the firearms market. So for Outdoor Holding to deliver a quarter like this, it absolutely defied expectations. Let's get into the numbers. First up, the bottom line. The company reported GAAP earnings, that's your standard by-the-book accounting, of 1 cent per share. Now get this, the consensus on the street was for a loss of 3 to 5 cents. So this wasn't just a beat, it was a huge swing from an expected loss to an actual real profit.
Okay, what about the top line? Revenue came in just shy of $12 million. That easily beat the Wall Street estimate of around 11.25 million. Now, yeah, it was basically flat compared to last year, but in this kind of market, just holding your ground is a pretty significant win.
And this is where the story gets really interesting. Adjusted EBITDA, which is a great way to measure core profitability, came in at nearly $5 million. That's up 24% from a year ago. This shows the company isn't just treading water on revenue, it's getting way more efficient at turning those sales into actual cash flow. So let's put it all together here. Just look at that net income line. A $1.4 million profit compared to a nearly $5.9 million loss in the same quarter last year. This is the first time they've been in the black on a GAAP basis in a while, and it's all being driven by strong margins and, most importantly, a serious focus on cost discipline. So you're probably asking, how on earth did they pull this off? Well, this was no accident. This amazing performance is the direct result of a massive strategic pivot that's been in the works for months. Management has a whole new playbook, and it's all about one word: focus. The company has totally transformed itself. It went from being this complex business, trying to juggle manufacturing with an online marketplace, to a streamlined, high-margin, asset-light machine focused entirely on its crown jewel, the GunBroker.com platform. And they weren't messing around. They sold off the ammo business, they moved their headquarters to Atlanta, and then, bam, they slashed operating expenses by a massive $6.7 million year over year. The new game plan is all about monetizing their platform, and they've also cleaned up their act by getting back into full compliance with NASDAQ. But the press release only tells you so much. The real gold is usually found in the Q&A session with analysts. And this time, it revealed what management is thinking about the two most important questions for the future: market share and costs. So, question number one on everyone's mind: in a weak market, is this great performance just because they're stealing business from competitors? Is the GunBroker platform actually winning? And the answer from the call was a resounding yes. The data is crystal clear. Adjusted NICS checks, which is basically our best proxy for industry-wide gun sales, were down 5%. At the same time, sales on GunBroker were up 3%. That's an 8-point spread, folks. That is exactly what gaining market share looks like. Okay, so they're gaining share. But what about those awesome operational improvements? I mean, after cutting nearly $7 million in expenses, is that it? Have they found all the savings, or is there more to come? And wow, the CEO's response on this couldn't have been more blunt. Steve Irvin said, and I'm quoting him directly here, "I think there's a lot more to come. This is the tip of the iceberg." When a CEO says something like that, it signals to investors that there's a clear path to even better profits ahead. So, with a fantastic quarter in the rearview mirror and a clear path forward, what's our take? What should we all be watching for as we head into the next earnings report? So, a few things to keep on your radar. First, we're obviously looking for them to keep expanding those profit margins for more cost cuts. We'll be glued to their marketplace KPIs, things like gross merchandise value and their take rates, and as some of those legacy legal expenses finally start to fade away, that could give another nice little boost to the bottom line. So you add it all up: the stellar execution this quarter, the sharp new strategy, and the runway for even more improvement. For us, that earns Outdoor Holding Company a rating of outperform. We think this company is set up to keep surprising to the upside. And now for our outrageous but plausible trade idea. Here's the thesis. We think the market is still underestimating just how much fat is left to trim. If the CEO is right and this is just the tip of the iceberg, we could see huge earnings beats for the next several quarters. So the action? One way to play this is by buying long-dated call options. It's a leveraged way to bet on the stock moving higher over the next year or two, and the target? If they can get anywhere close to their historical profitability, the potential upside here could be substantial.
And that's our breakdown of Outdoor Holding Company's killer Q2 results. And of course, a final, very important reminder, this is not financial advice.